All right, guys, I hope you're all doing well. This is the first video that I'm uploading of the beginner trading course that I've put together. So, the aim with it is that I'm going to give you guys the basic information that you need about trading, about technical analysis, risk management, so that you can then start thinking about progressing into the more complex stuff and actually start trading for yourselves and making some money. So, firstly, I just want to go through why I'm doing this, why I'm putting the Discord out there and why I'm doing this course. So, I started in 2020 trading crypto, and at first, I didn't know what I was doing. I was just blindly investing off other people's advice, made quite a lot of money, and then 2021 came, the market crashed, and I ended up losing most of the money. So when that happened, I decided that I wanted to learn how to trade myself and signed up to a subscription, yearly subscription, where there was technical analysis videos and he'd share his top picks for the month in crypto. So I learned quite a bit there, but I didn't really learn how to develop a strategy, and the videos were very broad and it wasn't really narrowed down to exactly what you need. So this is what I want to do with this course, and the Discord is give everyone the information that they need without the things that they don't need, and hopefully that'll reduce the learning curve massively. So the plan with the Discord going forward is I'm going to be releasing market analysis videos each week. So probably on a Sunday before the market opens, on a Monday. And with these videos, with the beginner videos, I'm going to release about 3 a week so that you can build the knowledge gradually and ask questions after each video is posted. And something else that I'm going to be doing probably next month is a mentorship. So with the mentorship, this is going to be me teaching all the strategies that I use to trade crypto, forex, the S&P 500, gold, teaching you the concepts, putting that together into strategies for you, and then teaching risk management, teaching psychology, teaching you how to journal your trades, how to pass funded accounts, and hopefully by the end of it, anyone that comes on will be able to trade for themselves. So, firstly, what is trading? Well, it's buying and selling financial assets or currencies to make a profit. And you can trade anything from forex, so that would be the euro against the pound, or the euro against the dollar, the pound against the dollar. You can trade cryptocurrencies like Bitcoin, Ethereum, Solana. You can trade commodities like gold, silver, even wheat and coffee, stocks as well. And I've put spot trading and investing here. So when I talk about trading, I could mean that I'm taking a forex position, a forex day trade that I'm opening at 9 o'clock in the morning and selling at 11 o'clock. Or I could mean that I'm taking a crypto trade that I might be holding for 3 months. So trading is a very wide spectrum, and you can either day trade or hold long-term positions. So this first video is just going to be mostly going over some key terms, terminology that I think you need to know to before going on to the other stuff. So firstly, entry. This is the price that you're going to enter a trade at. So when you want to go and put a trade on, you need to know where you're going to enter the trade, and you also need to always have something called a stop loss. This is the price where you will exit the trade for a loss. So when you go into a trade, you want to know exactly how much you're going to lose in that trade. And you can calculate this before you actually put on the trade. And it's essential that, especially if you're trading with leverage, which we'll go on to, that you always have a stop loss in place. Because if you have a stop loss, then you won't lose any more than you set out to lose. In the same token, you should always have a price where you want to take profit. So this is fairly self-explanatory. So with a take profit, you've got a price target where you will close the trade for a profit. And the different ways to actually put on a trade is, firstly, a market order. So this will be whatever price the asset is trading at. You will have the option to click market order, and the trade will be put on at the current price. But you've also got something called a limit order, which is you can set a specified price where you want to enter that trade. So let's take Bitcoin, for example. It's trading at $60,000, but you want to enter a trade at $55,000. So you will set a limit order at $55,000, and if price goes down to $55,000, then you will automatically be in that trade. So a long position is when you make money off the asset or the currency going up. It means you're buying it. But we use the term long because we also use the term short for the opposite way. So a long is, you'll know what this is when I explain it, but you are literally buying the asset or the currency. So you think it's going to go up, so you're going to take a long position. A short is the opposite of this. So you will make money if the asset is going down. So you take a short trade on the euro and it goes down, that means that you're making money. So that's one of the great things about trading, that you can trade both ways, and regardless of the market trend, you can make money. Bullish and long go hand in hand. So bullish means that overall your bias is that the market is going to go up and it's in an uptrend characterized by lots of buying pressure. Bearish, again, is the opposite. Market weakness has been indicated and you think price will go down. Therefore, you'll probably take a short position, or at least wait for a better long entry. So leverage trading. This is the act of using borrowed funds from a broker to open a position larger than your account balance. You'll usually get 100 times leverage given to you by that broker, and it's mostly used for Forex. Well, I mostly use it for Forex personally. You can use it for trading the S&P 500, use it for crypto like Bitcoin, Ethereum, which I do as well. But the reason that we use leverage is because you can capitalize as a trader with small capital. You can capitalize on fairly small price movements, especially if you're day trading. You know, Forex pairs move tiny percentages within the day. So if you want to take a day trade on Forex, in order to actually make a profit from it, a good profit, you need to use leverage, because if you were using just your own money to trade Forex, then you would need hundreds of thousands, if not millions, to actually make some money from it. Whereas you can just use leverage where you can take a position size much larger than your initial capital. So some key terms for leverage trading is margin. This is the amount of money that you'll need to open a position. A margin call is a demand from the broker to deposit more funds. So hopefully you'll never be in this position, because I'm going to teach you otherwise, and that risk management is key. But if you put $1,000 into a trading account and you're using leverage, so your profit and losses will be amplified, but the trade goes wrong and you are $800 down, so you've only got $200 in your account, the position keeps losing money, you will get something called a margin call, where they will ask you to deposit more funds, or if you can't deposit more funds, then you will be liquidated. So liquidation is, if you can't meet the margin call, then your account will be lost. All your money will be gone. So you can already see the risk of using leverage if you don't use it properly. Balance is the amount of money that you deposit to an account, and equity is the current value of your trading account. So let's say, again, you deposit $1,000, you've got a trade that's in profit by $200, your equity is now $1,200. Some more key terms. I'm sorry, this is probably going to be a bit boring for the first lesson, but it's things that you should probably understand before moving forward. So unrealized profit and loss is the current profit of your position whilst it's still open. So you should never class unrealized profit as actual profit. Until you've closed that position, you haven't made any money. So it's just important to differentiate between unrealized and realized profit. Lot size is the quantity of an asset you wish to long or short. So this will be the amount of the currency or asset that you want to buy with leverage. Position size is the total value of a leveraged position, so your capital and the borrowed funds put together. And a broker is the institution that gives you an account to be able to take leveraged positions. So overall, you need to understand these terms, but you can make your life a lot easier by using something called a position size calculator, which I'll go through in another video. And you can basically define exactly how much you want to risk, and it'll tell you the lot size of the amount of lots that you should be buying for that trade. Just the last slide on key terms. So pips. We use pips for Forex because, as I said, it moves such small percentages within a day. We use pips, which is the smallest possible price move in a Forex pair. So an example here is, if the euro against the dollar was trading at 1.15 and it moved to 1.1501, it has moved 1 pip. And I'll be going over pips in more detail and how I actually use pips to inform my trade decisions, but that'll be a bit further down the line. So the risks of leverage. Whilst profits can be amplified using leverage, losses can too. And this is where risk management comes into place. And if you're not managing your, eventually you will lose all your money. You might get lucky at first and make some good money because you were over risking, but eventually, if you don't practice good risk management, then you're not getting off to a good start. You're gonna lose your money. And my point is that keep risk management in mind from the start, and you don't really want to be risking more than 2% on a trade of your account balance. So the last slide for today is the different types of trading. So firstly, you can day trade, which is when you will take a long or a short position within a day and sell it that same day. So again, let's take the euro against the dollar, because this is I mostly day trade Forex. So I take a trade at 10 o'clock and I close it at 2 o'clock that following afternoon. So you're buying and selling within the same day. Swing trading is when you're holding a position for several days or weeks, maybe a month, because you want to capitalize on large moves in the market. So you've got an idea for the next month and you want to trade that idea. And you've got a bullish bias. So Bitcoin, this is a real life example. I've been bullish on Bitcoin, so I've been taking swing trades on Bitcoin to capitalize on the big price movements. Position trading is basically just a longer version of swing trading. So I will mostly position trade on cryptocurrencies where I will hold for months, maybe even 6 months, because again, I want to capitalize on big percentage increases. Scalping is basically a smaller version of day trading. So you will likely be taking numerous positions within the day, or you will take a trade and be out of it within 15, 20, 30 minutes. So I don't do much scalping. I prefer to day trade, but I can still teach you the concepts of how to scalp. You know, for all these four trading types, all the concepts are the same thing. Once you understand technical analysis, which we'll go through in the next video, you will be able to put strategies together for each of these different types of trading.